Hey everyone, Ben here with another video for Fluent in Finance, the channel dedicated to all things personal finance, encouraging you to earn more, spend less, and invest the difference. So let's get started with today's episode. So today we have a special episode for you. Unfortunately though, it doesn't apply to everyone out there. This particular episode is only going to apply to our low to moderate income earners. So if you're already a millionaire, congratulations! Subscribe anyway, as this channel has a lot of useful information for you. But unfortunately, this particular video is not for you. So as mentioned, this particular episode is only for our low to moderate blue-collar workers out there. But the good news is, for those folks, this particular tip and strategy could potentially 4x your money instantaneously. So we all know that the tax code is written by the rich for the rich, right? I mean, the rich get richer and the poor, well, you know. But that doesn't mean that there aren't little hidden gems, little golden nuggets that the little guy can't take advantage of. And this is one of those situations where the government desperately wants to give you some money. All you have to do is know about this particular trick, which I'm going to show you. You see, believe it or not, the government has a vested interest in having you save for retirement. Because if you don't save for retirement, then ultimately who's going to end up taking care of you when you get old? I mean, ultimately it's going to be the government that has to take care of you. And they're going to do this by various social service programs, you know, food stamps and Section 8 housing, that kind of stuff. Social Security alone is not going to cover your retirement. And so while they want everybody to save for retirement, they really want poor people to save for retirement. Because ultimately it's going to be the poor people who are most at risk of not saving enough for retirement, and therefore are statistically the most likely to rely on these government programs down the road. So in order to fix that and save this future problem, they want you to save today. Now, many of you already know that, you know, retirement accounts are already very tax advantageous. You know, whether that's a traditional IRA or a Roth IRA, whatever it is, they already have a set of tax advantages that go with them. But this particular topic is going to be in addition to all of the benefits that you already know about. So what we're going to be doing is we're going to be taking advantage of the 2019 Savers Credit. This was formerly known as the Retirement Savers Contribution Credit. So what this program does is it offers up to a 50% credit on your taxes, not a deduction, a credit on the first $2,000 of money that you put into your retirement account. Now, while the $2,000 is going to stay consistent for all of the people that get to use this program, the amount that they get to claim, 50%, 20%, etc., is all going to be based on your adjusted gross income. Now that's a mouthful, so let's slowly unwind and go back and explain this in actual English, all right? So let's say that we have a theoretical example. We have a single guy out there who last year earned $30,000. All right? And he is planning on taking the standard deduction when he files his taxes here in the next month or two. So the 2019 standard deduction is $12,200. So what we're going to do in order to calculate his adjusted gross income is we are going to take his total income, $30,000, minus his standard deduction, which, if hopefully I get the math right on this, is going to be $18,800 is his adjusted gross income. Now, maybe you guys itemize your deductions or you've got extra stuff going on, but for today's example, we're just going to keep it simple and assume everybody takes the standard deduction, all right? So as you can see in this example, with our individual who earned $30,000, his adjusted gross income is $18,800, which is going to put him, being in the single category, it's going to qualify him for the best category, the 50% contribution. Now, obviously, this gentleman can contribute as much money as his retirement plan allows. But for this particular program, it's going to cut you off after $2,000. So you can still contribute $3,000, $4,000, $5,000 to your IRA, whatever it is that you did. But this particular tax plan is going to only look at the first $2,000. So if this gentleman contributes $2,000 to a retirement account, and since he is eligible for the 50% contribution percentage, that means he will be eligible for a $1,000 tax credit. Now at this point, I think it's very important to understand the differences between a deduction and a credit when it comes to your taxes. You see, a deduction is going to reduce your overall income. For example, this standard deduction reduced your overall income from $30,000 to only $18,800. Now, where that comes into effect is, let's just say that this person then is in the 12% tax bracket. Therefore, if he had some kind of a program where he got a $1,000 deduction, and he was in the 12% tax bracket, the total amount of his refund then would be $120. But a credit is a straight line, this is how much money the IRS is going to give you. So if you have a $1,000 credit, you are going to get a full $1,000 refund when you file your taxes. So a credit is much more useful than a deduction is. And that's what we're dealing with here. We're getting credits. So now let's go back to our example of our gentleman who earned $30,000. Now, he does fortunately work at a company that offers a matching 401k contribution. But he's never actually taken advantage of that because he figures he's too broke. He's too poor. He can't afford to set aside any money for retirement. But after watching this video, he realizes that it's not going to be quite as expensive as he thinks to save for his retirement. So let's just say that he goes out and he talks to his human resources department and he tells them that he wants to contribute $2,000 to his 401k as part of his 2019 contributions. So he's going to put in $2,000. And yes, I understand that we're already in 2020. However, you have all the way up until April 15th of this year to make contributions to the year prior. So if you wanted to, you could still go out and contribute $2,000 to your retirement plan. And like I said, since this gentleman has a matching contribution at work, he contributed $2,000. His boss is also going to contribute $2,000. So quick math says his retirement account is now valued at $4,000. Pretty good start, right? You already doubled your money. But it gets better because we're going to 4x your money. Now remember, he contributed the maximum amount, $2,000, and qualified at the 50% rate because his adjusted gross income was below $19,250. So he is going to qualify for a $1,000 tax credit. So that means when this gentleman goes to file his taxes this year, the IRS is going to cut him a check for an extra $1,000. So they are going to send him $1,000. which means that realistically he didn't spend $2,000. He only spent $1,000 of his own money once you count that refund, but he's got $4,000 sitting in his retirement account. Talk about a pretty good return on your investment. Other examples would be if you are single and you have a child, so you're a head of household, and your total adjusted income was, let's just say, $30,000. So you would qualify at the 20% rate, which means that if you contributed the full $2,000, you would get 20% of that $2,000, or a $400 tax credit. So in order to take advantage of this, all you have to do is, if you have a 401k plan at work, go down and talk to your human resources department and let them know that you want to make a contribution to your 2019 retirement plan. And if you don't have a 401k at work, don't worry, it's super easy to set up an IRA at home. All you got to do is go online. Some popular choices are places like Vanguard or Fidelity, Charles Schwab. It really doesn't matter where you go. They all offer the same basic programs. So you're going to open up one of their IRAs and you're going to deposit some money into it. And when you make that deposit, it's going to come up and it's going to ask you very specifically, do you want this money applied to your 2019 or 2020 retirement contributions? So obviously you want this going to the 2019 plan. Now you might be saying, well, Ben, that's great, but even though you were able to 4x my money, I still don't have $1,000 just laying around. Well, that's fine. Do whatever you can. Do you have $500? How about $100? Would you be able to set aside $100 this month if it meant that your investment would 4x itself and now you would have $400 available to you? The bottom line is, do whatever amount you can. Get started, whether that's $5, $500, or $5,000. Now you do have to realize that it's going to take a little bit of time here. So you initially spent $2,000, and then if you file your taxes the next day, the IRS is pretty good. They're usually going to have a check in the mail back to you in about a week or two. So there is going to be that short little gap where you actually need to have the $2,000. So maybe do this right after payday. That way you have a large sum of money, you can plop it into your retirement account, and then you're not going to have actually any bills due for the next week or so. Maybe you put stuff on credit or something like that until the IRS is able to send you that refund check when you file your taxes. So if you are going to take advantage of this, you kind of want to time it maybe a little bit, especially if you're struggling financially and you truly are living paycheck to paycheck. So you're going to want to deposit the money into your retirement account and then make sure you file your taxes like the very next day. That way you can start getting that money back, that refund check back from the IRS as quickly as possible. Now it is also important to note that this program is an ongoing program, so it still is in existence for 2020. So you can use this next year and the year after and the year after that as well. But if you're just finding out about this for the first time, we're going to be using the 2019 version because, like I said, you can still contribute to the 2019 plan all the way up until April 15th of this year. So there you have it, folks. How to take advantage of a little-known tax loophole just like the rich do. And if you found this video useful, be sure to subscribe. I have new videos coming out every week. And leave a comment down below with how much money this program is going to save you on your taxes this year. Thanks, and I'll see you again real soon.